Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 29th episode of Carson's Facts versus Feelings podcast with Ryan and Sonu. I'm the Chief Market Strategist here at Carson Group. Sonu, what is your title?
It takes me a second. Vice President, comma, or slash, Global Macro Strategist.
There we go. The comma is very important. So, Sonu, we're going to talk. There's a lot to discuss. We were both on spring break last week. We'll talk a little bit about that, but we're calling this one just a bump in the road. We've had some recent economic data just last week that really took a turn, and we're going to definitely dive into some of that data, see what we see. We're going to end the discussion on a positive note. The jobs employment number. Monthly jobs number on Friday was once again solid. We'll dive into that. Then in the middle of the discussion, we're just going to talk about the stock market rally and some really rare indicators that have just triggered that potentially do suggest this rally that honestly is fairly hated very well can continue. Sonu, first things first, though, you went to Legoland. And I think my advice to you out in California, I guess San Diego, my advice was don't bump into them and knock any of the things over. You did not do that, did you?
No, and it wasn't just Legoland. Legoland, SeaWorld, the Safari Park. We went to something called the Flower Fields. We were out every day. Torrey Pines State Park. One tip I do have is that, I always take a backup battery charger for my iPhone, and I never think about that on personal trips. I'm like, am I going to use my phone? Duh, of course you use your phone because you're taking so many pictures, and then when you're bored, you're looking at Twitter or whatever, or Instagram or something, right? And you run out of battery power, right? So here I am in the middle of Legoland looking for an electrical outlet, right? And there's none to be found. There was none to be found. I found something in some random place, and here I am just standing with, my phone plugged in, and if somebody looked at me, I'm like, what is he doing there? But anyway, There's a tip for you. Take a backup charger when you go out with your kids.
Well, that's true. Take a lot of pictures. We were down in Turks and Caicos, beautiful island. Had a blast as a family. Went with some other families. We had a lot of fun. Stayed at beaches. I would highly recommend it. If somebody had some kids want to go somewhere nice, check out Turks and Caicos beaches. It was awesome. So let's just dive in again, though. So last week again, we're calling this one just a bump in the road. Our thesis is yes, we just had some weak economic data. I'm going to ask you about that in a second here, Sonu. But we think it's more just a bump in the road. So let's start with this question, though. We'll dive into the nitty gritty of the numbers. And you and I were kicking some emails around about this just yesterday. What the weakness we're seeing all of a sudden seems to be what they call soft data, the surveys versus the hard data, which continues to be pretty strong. Let's just, for the listeners, let's start the ground level. What exactly is soft data and hard data?
So soft data is data that you get from surveys, right? You ask people about, how is their company doing? What are their expectations for the future, for the near future and the long-term future, right? Hard data is actual data that's measured, like how many jobs did a business create? Right? How much goods did they produce? How much, how many goods were exported? How much was imported? Things like that. That's the hard data. So that's the difference between soft versus hard. And like you said, we are seeing, a dichotomy there, if you will.
No, absolutely. So let's just kind of get into it. I know, we started the week off with OPEC cutting production, energy bounced. Honestly, the market took that fairly in stride, so we might not talk too much there. Let's talk, services. We talked before, services makes up a huge part of the overall economy. The ISM services number, 51.2 versus 54.5 from 55.1. Bottom line, weaker than expected, still above 50, so still expanding, but dropping a little bit quicker. The manufacturing data in the U.S. also showed some cracks, if you will. Then the JOLTS data, the job openings, we're going to get into all this stuff, but that came in, that dropped faster than expected. So everyone's looking around last week thinking, maybe a recession is coming a lot sooner than we think. What's your take on the ISM data first off?
There were quite a few bumps, right? And look, the ISM, I've always looked at the ISM surveys. So this is the Institute of Supply Management. They survey and this is where rubber hits the road, right? Because they survey about 300 purchasing managers across the manufacturing industry and then the services industry, and ask them, okay, how are sales, how's production, how is hiring, are you seeing prices go up or down, things like that, right? But mind you, it's just about 300 purchasing managers, right? When we get actual employment data, things like that, we're talking about the Bureau of Labor Statistics asking hundreds of thousands of companies, right? So that's something the ISM is good in certain during certain times because it tells you, okay, what are people feeling, right? What sentiment, in a sense, right? Where is that going? Because that can be a good leading indicator at times. And right now, both the manufacturing surveys suggest that manufacturing is in a contraction. The manufacturing industry is in a contraction. This is just based on the survey, I should say. If you look at actual data, the data is, right now, industrial production is higher, slightly higher than it was in February 2020, by the way, just before the pandemic. So there's your, like hard versus soft, right? And then same thing with the services PMI, the Purchasing Managers Index. Say even that fell, as you said, from like something like 55 to 51. 50 is a mark where it says if it's above 50, the services industry is expanding. If it's below 50, it's contracting. So you're at 51. So we're kind of very close to, we are at that line, right, between contraction and expansion. So not very positive if you look at the surveys. But I think that's a general thing, right? Sentiment just seems poor all around. I know you look at sentiment all the time too, Ryan.
Absolutely. And you think about all the headlines we've seen. We talked a lot about Silicon Valley Bank and the fallout to, some of the more regional banks, smaller banks that deal with who? Small businesses. Just this morning, and I haven't had a real good chance to look into it, but the NFIB Small Business Survey came out. They looked at employment. I mean, employment was one of the lowest levels we've seen in several years. Implying maybe small businesses will slow down on hiring. We haven't seen that yet, but that's what the survey said. You mentioned the ISM manufacturing. It came in at 46.3. That was the lowest since May 2009. But so I want to dive into that a minute more. Manufacturing makes up approximately 11-12% of the U.S. economy, give or take on the day. But you mentioned industrial production. That's the hard data, right? That comes out monthly. That's still showing very few signs of slowing down. CapEx is still strong. But then the survey side is another. I mean, does it take time for these surveys to work? Or is it just people say one thing but do another?
And it's like I said, they're interviewing the purchasing manager at that company, right? Whether it's maybe Boeing, maybe that person's like, pessimistic, or I'm joking when I say maybe they got up on the wrong side of the bed that morning. Yeah, but no, I mean, in all seriousness, I'm sure they take these surveys seriously. They do it month after month. But there is pessimism that creeps in, like, SVB crisis, which is a genuine crisis. But I think we're past that right now because of what the Fed and Treasury did. But that affects people's minds and, their perspective on the economy and things like that. Whereas, look, Boeing just announced that they're going to build more aircraft this year.
Right.
That's hard data, right? Whereas the surveys say that, we're not so optimistic, right? So I think you have to look at both.
Yeah, well, absolutely. Just last week, Walmart, one of the largest, more influential retailers in the world, obviously, they reiterated first quarter guidance. They reiterated fiscal guidance. Jamie Dimon, obviously the main guy over at JP Morgan, Jamie Dimon said consumer spending is higher now than the previous year, than it was the previous year as of early April. So again, these things can change, but when you look at some of these things with the credit card spending, we've talked about that before. The consumer isn't really pulling back too much. And then, you were on the road, you took some pictures of how crowded it was. I was a very crowded beach. These things can change fast. We're not ignoring that. But as of now, the hard data gives a different story. Let's see, Sonu, let's maybe talk a little bit about the banking crisis, try to mold this together. So we've got some weakening economic data, and is it because of the headlines? Is it because maybe, again, these small businesses, which are the lifeblood, honestly, of the U.S. economy, they really are starting to pull back a little bit or get a little more cautious, and the fallout, again, from Silicon Valley Bank and what that means for regional banks and lending out to small companies is they're more concerned. There's no easy answer here, and the dominoes might be starting to fall, but hopefully not all the dominoes are falling. What do you think?
Yeah, I'm going to be careful here because I don't want to minimize the impact of when people say things aren't going things aren't going well. Look, last
Sure.
year, small business sentiment was really poor for understandable reasons. Prices were going up inflation is too high, right?
Yeah.
Right now, suddenly the crisis hits. Yes, I am sure, in fact, quite positive that, bank lending standards will tighten, right? But at the same time,
Right.
does that mean they will not get a loan? You know, I think they'll still get it, except they may have to pay a slightly higher interest rate, right?
Hmm.
Now, the small business or any business for that matter may decide to do that if they think, you know what, that's fine, that's justified because we see demand ahead, right? So, but at the same time, when you're asking about a survey, like, oh, do you think credit conditions will tighten? Yes, but they're not asking the
Sure.
question after that, right? Are you still going to apply for credit? You may still apply for credit, right? Yes, you may pay, instead of paying 5%, you may be paying 5.5% or 6%. But, just look at the housing market. People are paying mortgage rates at 6.5%. The housing market activity has gone down, but it's picking up again, right? So, people adjust to that new equilibrium in a sense.
Uh, some great points there. And you mentioned sentiment a little bit ago. Our friends at CNBC did a survey. They looked at 400 investment professionals. Now, I was not in the survey. Were you in the survey by chance,
No,
Sonu? I
no,
wasn't.
I,
Okay.
I, I don't
All
get
right.
those
So
calls.
I assume not. So this is, I think this is fascinating because again, these are probably people that write for CNBC, go on CNBC.
Hmm,
They looked at 400 professionals, 68% of them. This was, by the way, this was as of the end of the third quarter. So this report
okay.
came out, or the survey came out the first week of April, just last week. 68% said there's more room for stocks to fall. 16% said we're relatively close to a bottom, and only 16% said we were beginning a new bull market. So again,
Wow.
but again, with all the headlines and the worry that's out there, I guess maybe it's not overly shocking. I was on CNBC yesterday, so today's Monday, or Tuesday, so I was on Monday, and talked about a lot of the things we talk about on this very podcast with some potentially glass half full type of mentality, and on Twitter, no matter what you do, you seem to get the trolls out, and that's how it goes. But I had a lot of people say that was really nice to hear the other side of the story. We never hear the other side of the story on
Yeah.
CNBC. And I listen, I don't know if that's true or not. I watch CNBC and they've got bulls on there, but still, that's the mentality that it's just a lot of just doom and gloom. Yet, we've seen this slowdown, but we're going to point out some potential positives. I mean, Sonu, let's talk about JOLTS here. And I'll let you explain what it is. I'll just set the stage here. So JOLTS is the job openings. The Fed wants this to go down. It peaked around 12 million, give or take, I think last year around this time, approximately. And the number continues to go down, but the market kind of freaked out on the day, whatever day it was last week. I was on a beach drinking something with a little umbrella in it. So I forget exactly.
And I was
which
in
day it was.
Legoland.
Yeah, you were in Legoland trying to charge your phone as you run, pushing children out of the way, looking for a charger. No, I'm kidding, you didn't do that. But why? If the Fed wants things to slow down, JOLTS is a big thing they're watching it slow down. Markets seem to, maybe about the market, maybe the media. Let's say the media. The media seem to kind of freak out, like, oh boy, more sign of a slowdown. Square that circle for me?
And I think even markets actually, I don't know, freak out. Yeah, but bond yields went down. When bond yields go down, that means they think economic growth in the future is going to soften, right? That's your first clue. Like, oh, what does a bond market think, right?
Mm-hmm.
Yeah. So we had the SVB crisis. That was a bump, right? And then the JOLTS report came, as you said, job openings fell by this is in February, fell by about 600,000 to just under 10 million. It was about, I think, the peak was about 12 million or something like that last year, right? And like you said, look, the Fed, the irony is
March of 22. I'm looking at my notes.
22.
12 million March of 22. So about a year ago. Yeah.
About a year ago. Right. And now we are below 10 million. So openings have fallen 2 million. And just on the face of it, if openings fall, what does that tell you? That tells you that, maybe employers don't want to hire as much. There's the demand for labor is softening, right? But the irony is this is exactly what we've been waiting for, right? Fed Chair Powell, he loves to cite this metric on a openings to unemployed workers, a ratio, right? That was 1.2 before the pandemic. It jumped up to 2, last year.
Mm-hmm.
Now it's down back to about 1.65, 1.7, something like that, right? That means that supply-demand picture of the labor market is starting to get a little more balanced. I mean, you and I have talked about issues with counting job openings, right? It's so easy to put up a job right now. Companies may forget to take it down, or they may not care again. Who knows how? I think the BLS does a fairly reasonably good job of counting job openings, but there's still issues with that metric, I think. And so all this to say, I think, as you said, the market saw job openings fall and say, demand for labor is softening, and that's not good news, right?
Yeah,
And
but
then,
which again, the Fed wants that though.
yeah, exactly. And then you get the other thing that happened last week was the BLS came and revised all their unemployment claims data going back to 2018.
Right.
And this is not so they take the actual data, which how many people are applying for unemployment benefit claims, and how many people are continuing to do that week after week after week, right? And then they make seasonal adjustments because during certain times of the year, more people apply for that. During other times of the year, there are not many people applying for benefit claims. So they make seasonal adjustments. So what the BLS did is they revised all their seasonal adjustments. So everything went kind of haywire, right? Long story short, continuing claims have been rising since October. And initial claims, when people get laid off, they first file for unemployment benefits. That was higher than we thought previously. So again, not a good look, right? And I think that's combined the JOLTS data with the unemployment benefit revisions that the BLS made, and you had the makings of, the sky's going to fall.
Well, exactly. And we had that big rally, from the second half in equities from the second half of March until the first week of April. Last week, stocks pulled back a little bit, but it wasn't like we had a massive sell off.
No.
I was looking at my notes here on the JOLTS, the job openings. Actually, Sonu, if what I read was correct here, hires at small business firms actually increased. It was hiring at larger businesses that decreased. That is pretty interesting, given what we just talked about, which is small businesses are saying one thing in a survey, but apparently they're doing another. Do you want to add to that?
I mean, all I could say is, watch what they do more than what they say. And I think that applies to the consumer as well. It's not like consumer sentiment right now is very positive. It's better than it was last year because inflation's come down, but it's still low compared to where sentiment was before the pandemic. I think people are a little upset about various things going on. I mean, we're still getting over COVID, and prices are still higher than we've been used to. So if you ask most people, like, oh, is a recession likely? Not to mention all the headlines they're saying, yeah, a recession's likely. But then go look at how much they're spending at Walmart, at Target, or things like that, and or they look at the airports; they're all full, right? I mean, that tells you a lot in and of itself.
Yeah, I fly a lot, and every time the day or two before you start getting those emails, hey, are you interested in moving your flight? We'll give you some credits. How many credits will it take for you can click, anyway. So clearly there's it's lifelong Cincinnati Bengal fan. A lot of people know that. Marvin Lewis was our previous coach. I hope I say this quote correctly. Marvin used to say, I see a lot better than I hear, implying players would talk about, oh, I should be playing, I should be doing this. Marvin's like, no, I see how you play on the field. And that's somewhat like what we're seeing right now with the economy. We see continued better things than we're hearing, which is just a lot of negativity. So, Sonu, that was a really good discussion. Again, as we titled the 29th episode of Carson's Facts versus Feelings podcast, just a bump in the road, which we think this is just more of a near-term blip. The hard data remains strong. So, Sonu, I don't know. We haven't ever talked about this. We're going to take a little curve here for a second. Do you watch the show Succession on HBO by chance? You ever heard of it, or you watch that one?
I'm a fan of the show.
Are you caught up with what just happened in the third episode?
I'm not. I like to binge these things, so I'm waiting for everything, all the episodes to come out, and then I'll just watch it, in one night or 2 nights or something.
Yeah, well, given it's kind of the world of finance and
it's a great show.
Business, and boy, oh boy, I'm not going to give it away, but the third episode in this last season.
Oh, really?
Wow. It was coming. Okay. Wow. But it's pretty awesome. So I'm a fan. What so I really like that one. Do you have a favorite HBO series you've ever watched?
I started my favorite HBO. I really like The Wire from way back in the day. So that's one of my favorite. But I'm watching Billions now. I recently got into it. My wife doesn't watch
that's Showtime. But I got
Showtime. Yeah, that's Showtime.
Yeah.
But
I've never
been getting into speaking of finance. It's got moments in there to keep you. Hey, it's trying to pass time. So
Yeah. Final comment on
works.
this. Yeah, I love The Wire. It was great. What I like about Succession is they're only doing 4 seasons. I do feel sometimes
Oh,
these shows go on a little long. They're making money.
yes.
Everybody's making money. Let's just go 5, 6, 7, 8 seasons. I like the idea that they're only going for 4 on Succession. So, all right. So let's get back into it here, Sonu. You've got a meeting, I believe, in 12 minutes. So we have to wrap this up. What's your
Okay.
meeting? I don't even know who you're meeting with. What do you have? Is it real important? Can you go longer for the listeners?
I'm meeting a Jessica. Shout out to Jessica, who makes
Oh.
everything happen on our investment team. So
Yeah, we don't want to be late. You don't want to be late for that one. So we'll make sure we're done in time. All right. So the market update here we're going to do, and I've got some just stuff I want to point out here. We've seen some really unique things take place. Unique is in potentially bullish, and believe me, we talked about market sentiment. We've talked a lot about this. Yet the S&P was up over 7% in the first quarter, the best start to a year since 2019. Let's not forget, 3 months ago, right now, you and I were talking on this very podcast about the average strategist, according to a Bloomberg poll. Again, we're back to using polls, nonetheless, was negative for the year. All right. And we've like never seen that. We've never seen the average strategist looking for negative stock returns. Oh, by the way, stocks are down 20% the year before. So that's a lot of negativity. But here we go, Sonu. I'll just kind of rip through some of these. More than 93% of all the stocks in the Ned Davis universe, so looking at small caps, mid caps, all of them in Ned Davis follows. More than 93% of them recently were above their 10-day moving average. That's what we're calling a breadth thrust. All the listeners need to know when this rare instance happens, the S&P has been higher a year later, 23 out of 24 times, up over 18% on average. When the first quarter gains at least 7% for the S&P, like we just did, the full year, ladies and gentlemen, has never been lower for the S&P. Yes, some years it was down the final 3 quarters. I'm looking at U87. Most of the time, though, stocks do pretty well, which leads me to the next one. When the first quarter is up at least 5%, the next 3 quarters have been higher 15 out of 16 times. 87 was the one time stocks were down after a good start to the year, up about 10% those final 3. And then one final one on this, Sonu, because I could go all day, but I think these are really interesting and fascinating, and people need to know them. When the S&P gains at least 5% 2 quarters in a row, remember 7.1% the fourth quarter, 7% the first quarter this year, simply that just doesn't happen in bear markets. It's not a bear market rally. Normally, that's a sign of a new bull market. 4 quarters later, higher 87% of the time, up 13.5% on average. I think last week we talked about the December low indicator. When you don't break the December lows on the S&P 500 in the first quarter, the December lows in the first quarter, the full year has been higher 94% of the time, up 18.6% on average. Now, believe me, I could probably spout some bearish stuff too. What I see from a technical and sentiment point of view, momentum point of view, what I just listed there, it's hard to be overwhelmingly bearish. In fact, I think you should be overweight equities, which is exactly where we are in our portfolios. Sonu, so let's say equities do better this year. How would you position a portfolio right now for the remaining 3 quarters?
I think you said it right. Yeah, overweight equities, and at the same time, that look, there'll always be bumps on the road, right?
Yep.
So there's always bumps, and it's never like 1 or 0. Yes, we know for sure there's no recession. Yeah, our base case is there's no recession, but there's some reasonably significant probability of a recession. You never know what will happen. Maybe 20% or something, Ryan? I mean, these are just throwing numbers out there, but
I'm going with 21.2%.
Okay, 21.2% recession. So you got to hedge for that, right? You hedge with maybe, bonds or long-term treasuries or something like that, which historically have
gold
gone
also.
up.
Remember, we talked about gold last week.
Yeah.
Yeah.
And gold does well during crises. So you hedge some of your overweight equity position with a little bit of gold. That's what we've done in our portfolios. So I think that's in terms of portfolio construction, you want to be aware. There's never any certainty as to what macroeconomic regime you'll be in, right?
Sure.
So you want to play that, but you make certain tilts as to your position for, in our case, our base case is that there's no recession. We are positioned for that.
Absolutely. And so, I mean, your job, and what's your title one more time? VP, comma. What's that other part of it?
VP, global macro strategist.
Global macro strategist. Yeah, exactly. Gotta add the comma. But you do such great work for our Carson partners as you manage the models and portfolios that we run on our team for our advisors to leverage and use and make their lives easier, right? For their clients, and that's kind of what's neat about it. I think what we do here, the Carson Group, is we're doing podcasts, we're doing quarterly commentaries, we're doing weekly commentaries, quarterly videos, we a daily blog, we're all over Twitter.
Yeah.
Our views are out there. Whether we're right, whether we're wrong, they're going to be out there. And I think the neat thing about us is we look at the data and we're willing to change our views. Now, trust me, if so many people you see with this perma bears and perma bulls, they just dig their heels in. And if the data changes, I think we're willing to absolutely change our views. But what we've talked about on this podcast, and you laid it out in a macro point of view, we just don't see a recession as of the base case now, and we're staying overweight equities. Now, one more, Marty Zweig. You a big fan of him? You read any of his books or followed him, Sonu?
Yes, one of the first. He had those 3 things about the stock market and things like that. This is one of his older books. This is at least 20 years old.
Yeah, I mean, we've all heard "Don't fight the Fed" is one of them. He's got some other really famous sayings, but he had something called the Zweig breath thrust, similar to some of the other things I just talked about. But and I don't want to get too in the weeds on this, like a 10-day exponential moving average of how many stocks went up versus down on the NYSE. We'll keep it real simple. When you go from very oversold to very overbought within 10 days, that's a breath thrust, according to Marty Zweig. And we just had the 15th trigger, because I got the data from our friends at Ned Davis and crunched the numbers. There have been 14 previous Zweig breath thrusts. We just had one about a week and a half ago. A year later, the S&P is higher 14 times. That's every single time. Now, you could say small sample size. I'm not disagreeing with you, but 14 out of 14 higher, 23.3% on average on the S&P after a Zweig breath thrust, which is something we just saw recently, along with those other things. So, Sonu, we've got a couple minutes. You got to meet with Jessica. What's going to mess this up? I mean, we just laid out some positive. What's going to trip this up that we do maybe fall into recession, or we do have a rough go for stocks? What do you think could be the tripwire?
Goodness. I mean, it could be any number of things. I mean, obviously the Fed raising rates, keeping rates, too tight. But it's hard to get away from, just goodness, we didn't spend too much time talking about the payroll report from last Friday.
Well, that's next. That's our final conversation. Yeah, that's next.
Yes.
Yeah.
But talk about another breadth trust from the economic standpoint, right? But yeah, we talked about like the banking crisis. SVB nobody sort of predicted it. In fact, a lot of analysts, I think, knew, even their auditor knew that their balance sheet was not in great shape, but nobody could have said, oh, we'll have a crisis and maybe even a systemic crisis because of that, right? So these things can come out of the blue, so to speak. But again, it goes back to when you're managing portfolios, when you're constructing portfolios, you want to be prepared for that as well. You'd never position yourself 100% one way or the other.
Mm-hmm. No, absolutely. So let's finish things up maybe on a bright note. We mentioned some of the negatives on the economy, some of the economic data that we've seen, mainly, again, the soft data. But on Friday, we had the jobs number, which is kind of funny because Friday was Good Friday, the holiday. So a lot of people weren't really paying attention, but we had May created 236,000 jobs versus 230. Friends at Bespoke said that's the 12th time in a row the jobs number came in better than expected. That's never happened before. It's the longest streak ever of beating estimates. Sonu, the headlines feels like a broken record. So better than expected. We made over like 1 million jobs in the first quarter, really strong. Wages continue to slow. Employment continues to be strong. I mean, it seemed like I swear the last 2 reports, we called them Goldilocks reports. We're still there. I mean, what's your take on that jobs number?
I mean, there's no way to say it. It was just really strong, right? It's very positive, especially because remember, Jan and Feb were huge numbers in terms of job creation. So there was a sense that, that's a lot because of weather, seasonality, as opposed to actual underlying labor market strength, right? So, I mean, even me, I thought maybe we'd see a bit of a correction in March, maybe just about 100,000, between 100, 150,000 jobs or something like that, maybe even less to correct for the strength in Jan and Feb. Q4 2022, so the last quarter of 2022, average job growth per month was 284,000, right? So coming in, I thought maybe we'd be there just about, maybe slightly low, maybe average 250,000. So which means, the March numbers would have to correct for the strong growth in the first 2 months of the quarter. But we got 236,000, as you mentioned, right? So the average in Q1 was higher than Q4 of 2022. The average is 345,000 jobs a month. And with these things, the monthly numbers can be volatile, right? As we know, I think it's nice to take an average. So, I mean, at some point, we got to say, just look at the reality of the economy and say, where is the slowdown here, right?
Yep.
I mean, just a month and a half ago, we were talking about no landing. Remember that? And I think I'm still kind of in that camp. I mean, that's not to say things are accelerating, or it's not to say things are not slowing down. I just think, hey, the plane's still up in the air. Right?
Yeah,
it's
by
still
the
up
way,
in the air. That's it.
When we were getting that strong economic data around the middle of February, late February, saying weather was better, remember what stocks did? Stocks sold off during that time. So remember last month also we created 311,000 jobs. We made the 311 joke all mixed up. Yeah. That was actually revised higher by a little bit. We had that huge over 500,000 in January. We all assumed that would be revised lower, and it has been, but not by much.
It's just down to 470,000. Yeah. Look at the unemployment rate, right? Unemployment rate is 3.5%. So we've got wage growth going down. We got job openings going down. And normally, even if you ask any Fed official, any economist out there, I joke that I'm not an economist, but if you ask most people, it's like, oh, that means the unemployment rate would have gone up. But wait, it's at 3.5%. It's just a tick above 3.4%, which was the lowest in 50 plus years.
Yeah.
That's one of the big... That doesn't happen without a strong labor market.
Exactly. And that's one of them. Believe me, we've kind of hit the end of the road on the 29th episode of Carson's Facts versus Feelings. That's one of the things that we hear a good deal about the worry is unemployment's low. And once it starts to trickle higher, it can move higher in a hurry. Well, we haven't seen that yet. Yeah. So with all of that, everyone, Sonu does have a very important meeting with Jessica. Sonu, in 15, 20 seconds, any final comments on this week with the inflation data? Anything you're watching as we wrap this up here?
It's a big week. We've got inflation, CPI data, which I think maybe, especially core inflation, maybe on the stronger side. But I think we're all kind of waiting for the housing market rents data to trickle into the official data, right? So for now, I think most people are sort of looking past the inflation data. I mean, I'd be worried if energy prices suddenly shot up. But despite the OPEC cut last week, we haven't seen that. So that's good news, right? And then we're getting retail sales and industrial production. So, a lot to watch for.
Yeah, so there's a lot to talk about next week, on which will be the 30th episode of Carson's Facts versus Feelings. But everybody, thank you so much for taking some time this week. As always, Sonu and I have a blast doing this. You guys keep listening to them. We will keep doing them. I think we are literally at the bottom of the hour, Sonu, as we record this. So you hopefully are not late to your next meeting. So we'll see everyone very, very soon. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.